Yeah, this accounting A level. I'm taking investment ratios. So when we talk about investment ratios, basically we're talking about investments. So for investment ratio, this is the relationship, this is the measurement in terms of the relationship between the amount of money invested by the owners of the business and the profits they made. So that is what investment ratio is about. So it measures the differences between the amount of money invested into the business and the profit made by the business. That is the investment ratio. So how do we go about investment ratio? For investment ratio, how do we know if the business is doing well or is not doing well? A business will be doing well if, based on the dividends being shared, it can be measured based on the dividends being shared to shareholders. We're talking about the profit sharing to shareholders. So if the dividends given to shareholders increases, it means the business is doing well. So one of the ways in which we can know or monitor our investment ratio. The second one is about the capital growth. And when we talk about capital growth, we're talking about the increase in the value of the shares of the company. That's what capital growth is about. So investment ratio will bring about, or we get to know more about investment ratio or return on investment, in as much as one, the value of the business shares is increasing, or the dividends to shareholders are also increasing. So these are the two ways in which we can understand the return on investment. Then that takes us to different types of investment ratios we have. One, we have profitability ratios. For profitability ratios, this ratio measures performance and examines the extent of the profit in relation to the size of the business and the amount of capital invested. So when we talk about profitability ratio, we're talking about the amount of money invested by the owners of the business, the amount of capital invested into the business, and the profit made by the business. So how do we calculate this? We can calculate this through, one, the gross profit as a percentage, the net profit as a percentage, and the return on capital employed. So for the gross profit, we're talking about the gross profit margin, which is the gross profit divided by the total revenue multiplied by 100. That is the gross profit. And for the net profit, we're talking about the net profit divided by revenue multiplied by 100. Then we have the return on capital employed, ROCE. For return on capital employed, it is the net profit before interest divided by the capital employed multiplied by 100. So how do we get the capital employed? The capital employed is the issued share, that's the ordinary shares, plus reserves and non-current liabilities. So the sum of your issued share, your reserves, and non-current liability makes up capital employed. So that takes us to the question we have here in activity 2. For activity 2, they said the revenue of the business is there. For calculators, PLC, there's revenue, there's opening inventory, there's purchases, the closing inventory, the cost of goods sold, and we have all the information here. So we quickly go into the question itself. They said calculate the gross profit margin. For gross profit margin, this will be gross profit here is for each year for 2018. The gross profit for 2018 is 8,900 divided by the revenue, which is 44,800 multiplied by 100. So let's do the calculations here. Hold on, please. I'm trying to do the calculation. I'm going to open the calculator now. Or calculator. So here we have the calculator. So the gross profit margin is gross profit for 2018, which is 8,900 divided by the revenue, which is 44,800 multiplied by 100. That gives us 19.86. And we're told to give our answer to the nearest one decimal. So for the gross profit margin for 2018, it is 19.9. 19.9. Then for the net profit margin for 2018, it will be net profit. So here we have our net profit after interest before tax, and we have net profit after tax. So how do we get our net profit? Our net profit will be the net profit. They said our net profit will be net profit after tax, which is 4,224 divided by revenue, 44,800 multiplied by 100. That is 9.4. So our net profit margin is 9.4%. Now we go to the return on capital employed for 2018. Return on capital employed for 2018 will be net profit before interest. Our net profit before interest, how do we get our net profit before interest? We check our statement of profit or loss. Here we don't have net profit before interest, but we have the gross profit, we have the interest payable, we have net profit after interest but before tax. So how do we get our net profit before interest? Our net profit before interest will be the gross profit minus net profit after interest but before tax. So that will be net gross profit, which is for 2018, 8,900 minus net profit after interest but before tax, 4,345. So our net profit before interest is 4,555. Now, how do we get our capital employed? Our capital employed are one, the issued share, which is 5,700 for 2018. So it will be 5,700 plus for 2018 plus reserves, which are the reserves 4,700 plus non-current liabilities, which is 6,000. So that will give us the final answer for return on capital employed. That means 4,555 divided by the total value of the addition of the sum of current non-current liabilities plus ordinary shares plus reserve. So whatever we get to give us our return on capital employed for 2018. Same goes to 2019. For our 2019, we're going to have the gross profit for 2019, 11,180 divided by the revenue, which is 52,620 multiplied by 100. The net profit will be net profit after tax, 5,312 divided by the revenue, 52,620. Then our return on capital employed will still be the same, which is gross profit, net profit before interest and tax, which is gross profit minus net profit after interest but before tax, divided by the issued share, the non-current liabilities plus reserves. So that is how we calculate profitability ratio. Our profitability ratio are gross profit margin, net profit margin, and return on capital employed. Thank you.